Okay, so now that we understand the indicators and the chart templates that are used for the Alchemy system, let's talk about some entry and exit rules. Okay, first of all, the first thing we want to look at is what we call a valid X cross. Well, what does that mean? Well, to start off with, let's remember two indicators that we've looked at. The first one is this one here called the volatile trend line. Remember that one? It's either red or green. Goes up and down, red and green. Very simple, right? The other one is the trend flip. This one that's red, or right here, see it pops down, turns to green. Here, turns to red. Okay? So we're looking at the volatile trend line and the trend flip. Notice the volatile trend line comes down. Okay, it's following right here. And then what does it do? It makes an X. It crosses the trend flip. See that? Trend flip is red. Right here makes a straight line down, turns to green. Creates an X right there. Okay? So, that's an example of this is a long entry, of a buy entry. The volatile trend line must cross into the trend flip upwards for a buy, creating an X. So volatile trend line has to cross upward into, got to cross up into the trend flip, creating that X for a valid buy or long. Let me show you another example here real quick. Let's look at a valid short sale. Notice the volatile trend line coming up right here. See right here it turns to red, comes down, and what does it do right there? See that X? It crosses the trend flip line from above coming down. That would be a valid short. Let me show you real quick here just to make it clear on a chart. Alright, here's the volatile trend line. And what does it do? It comes down and it crosses over the trend flip. This is the trend flip. Okay? Right here. See, trend flip is green. Then the trend flip comes up, goes to red. Trend flip comes down right here, turns to green. So, the volatile trend line crosses from above into the trend flip, creating an X. That's the first step for a valid short sell. Notice down here, volatile trend line's coming down, then it comes up. And what does it do? It crosses from beneath, it crosses up into the trend flip. That would be the first setup for a buy. Okay? So pretty simple there. So that's the first thing that we're looking for. Okay? Is a valid cross, or what we call a valid X. And on a buy entry, what we're looking for is to have a green trend flip. Okay? Which, for example, right here, trend flip is green. Okay, well, first of all, we're looking for a valid X. The X could have happened, ahead of time. But right here, the X happens. That's the first thing we're looking for is an X. Then the trend flip has to be green. The volatile trend line has to be green. And green trend bands. Okay, remember the trend bands? See the red band, the green band, not the color of the bar. I'm not talking about the color of the bar. I'm talking about the band. All right, so red band, green band, red band, green band. Okay, so we have to have a valid X cross. Trend flip has to be green. Volatile trend line has to be green. And the trend bands have to be green. And we're looking for a green bar. Remember the bar color chop filter colors the bars either red or green. So we have a valid X and it crossed from underneath coming up, so that set us up for a long or a buy. Volatile trend line is green, trend flip is green, the trend bands are green, and it's a green bar. So as soon as that bar closes and everything lines up, we're entering one tick above it. We're entering as soon as this next bar opens up. Okay, so this bar closes. When this bar closes, we see that everything is lined up. We enter one tick for a buy. Okay, very simple. Now, Let's look at a short sell. Again, volatile trend line crosses from above, crossing down over the trend flip. So it creates a valid X cross. All right. Also, when that bar closes, what color is, see the trend bands here are red coming down, trend bands are green, trend band is red. So volatile trend line crosses, we've got red volatile trend line, red trend flip, we've got red trend bands, and we've got a red bar color. Okay, so that's a setup for a short to sell. So as soon as that bar closes, we see that everything lines up to proper color. One tick below that bar, as soon as that next bar forms and it breaks by one tick, we're entering a sell to go short. All right, very, very simple. Once again, down here, see, volatile trend line crosses from above, crosses the trend flip from above. We've got red trend flip, we've got red trend bands, we've got a red bar, we had a red flip, that's a short. Okay, what is this right here? Volatile trend line's coming down and does what? Comes up, crosses the trend flip from beneath, comes up. So we have a valid X. That's the first thing we're looking for, is a valid cross. We've got a red or green trend band right here. Green bar, green volatile trend line, green trend flip. When that bar closes and everything lines up green, we enter one tick above it. Very, very simple there. So for entries, we're first of all looking for a valid cross. Okay, and we're looking for 4 indicators to line up. All right, very, very simple. Now, something we talked about earlier. Okay, or well, we haven't talked about this. This is called a valid V bounce. Let's talk about that. Okay, because we're looking for a valid cross. But what is a V bounce? Well, might be a little difficult to see here, but you see the volatile trend line actually came down and crossed from above. It crossed down into the trend flip. See the trend flip right here? Trend flip's red, trend flip's green. The volatile trend line actually crossed down. So normally what happens what are we looking for normally when the trend flip crosses down? Well, we're only looking for short sales, right? But if the volatile trend line crosses down and then right here, boom, bounces off the trend flip and makes a V. You see that? Boom, it's a V. That is also considered a valid V bounce, or still considered a valid X. Let me show you an example on a short here. Okay, volatile trend line is coming down, crosses up into the trend flip, which would normally mean an up sale. But notice it pops up and hits it and makes a V. It makes a V bounce right off of it. Okay, and let me show you another example here on a chart. Here we go. So right here, volatile trend line's coming down, comes up, and then what does it do? It comes up again, crosses the trend flip up. But see that? Boom, it hits it and makes a V, pops back down. That is still considered a valid X or valid entry. So we call a valid V bounce, which would be the same thing as a valid X. It might cross the wrong direction in a sense, but it pops off and makes a V, still a valid entry. Okay, so does that make sense? The first thing we're looking for an entry is that crossover X. Okay, cross over for a sell, cross from underneath for a buy. But if it crosses the opposite way but makes a quick V bounce, it's still considered a valid entry. Okay, it's called a V bounce, but it's considered a valid X. All right, and then again, what's happening? It makes that V bounce. We have red trend flip, we have red volatile trend line, we have red trend bands, and we have a red bar. So that would be a valid entry. Okay, or on the long, crosses the opposite way, it makes a V bounce, and we still have the 4 indicators lining up. It's a valid long trade. All right, so we're looking for that valid X or V bounce. Then we're looking for the 4 indicators to line up the same color. Now, something that we talked about earlier was the trendar indicator. This right here, remember? And all we're looking at is what? The zero line. And is the trend-R indicator above the zero line or below the zero line? Basically, is it green or is it red? Simple as that. And remember, we talked about it's a chop filter, just like the bar color chop filter. So what if we have a valid setup to go long, for example, and we've got a valid X crossover, we have green volatile trend line, we have green trend flip, we have green trend bands, but we have a yellow bar. What does yellow bar mean in the bar trend chop filter? What does a yellow bar mean? It means we're not out of chop. So technically, we wouldn't be taking that trade, right? Because we need what? 4 indicators to line up. But remember what happens when the bar trend color may not be the right color, but the trend-R is the right color. The trend-R is above 0, it's green. Then the trend-R can override the bar color. And therefore, you once again have 4 indicators lining up the same color. Okay? So, for a valid entry, the trend flip, for a valid long entry, for example, trend flip has to be green. Volatile trend line has to be green. Trend bands have to be green. Those 3 have to happen. Trend flip, volatile trend line, and trend bands have to all be the same color. Those 3 have to be the same color. And then either the bar color also has to match the color, or the trend-R has to match the color. So you need 4 out of the 5 indicators to line up. Okay? But the trend flip, trend line, and trend band have to line up. From there, it can either be the bar color or the trend-R that can be your 4th indicator and make it a valid entry. Okay? Pretty easy. Let's look at a short example. Volatile trend lines coming up, crosses down, right? Crosses from above, crosses down, crosses the trend flip. So that's our first thing we're looking for. And when that happens, what do we have? We have red trend flip, we have red volatile trend line. Look here, we also have a red trend band. You see the trend band? It's red. So those 3 line up the right color. But what is the bar color? It's yellow. So we don't have our 4th indicator, right? But look, the trend-R is red, below 0. So boom, it overrides that bar color. It's a valid short to go short down to sell. Okay, so very, very simple. We're looking for a valid X crossover or a valid V bounce. We need trend flip, volatile trend line, and trend bands to line up the same color. And then we either need the bar color or the trend-R to line up the same color, and we enter the trade. All right, so pretty simple there as far as your entry rules. So one other thing we look at for entry, okay, is the expected volume. All right, so we know, first of all, let's just recap one more time here. What we're looking for a valid entry. All right, here's an example of a short entry. Volatile trend line crosses from above, crosses the trend flip. Volatile trend line is red, trend flip is red. Red trend bands, and we have a red bar color. We also happen to have a red trend-R at the time, but we don't need both, but they happen to be both right here. We also have exceeding volume. Remember, when the blue shade is above the yellow line, it's higher than expected volume. Okay, so higher than expected volume is a better entry. Okay, you can take entries without exceeding volume, but it is not recommended. It is not part of the system rules. All right, the better entries do have exceeding volume. Why is that? Well, when all these indicators are lining up and everything's lining up perfectly, saying, hey, the market's headed down, When you see exceeded volume, meaning more volume than normally expected, that means most likely the market's heading down with a little bit of oomph behind it, with a little bit of volume and pressure behind it to keep it going down, which is obviously what you want. So, valid X crossover, valid V bounce, those three indicators lining up, and then either the red bar or red trend bar and exceeding volume, you enter the trade. Okay, so very, very easy there. All right, the recent X or crossover does not have, the X or crossover does not have to be on that same bar. It could have happened a few bars earlier. You'll even see times where the volatile trend line will cross over the trend flip, but it might still be a different color. So you're waiting for those to line up. So as long as you've had a recent X crossover, all those colors line up, trend R can override the bar trend chop filter, and you need expected volume. So you've entered a trade. All right, we know how to enter a trade. We know when to enter a trade. Well, let's talk about when we get out of a trade. All right, here's an example right here of a valid long, right? Follow trend line crossed from underneath. Everything is green. We entered a trade. When we enter a trade, there's two places we can take profit at. Okay, and I'm going to show you two examples here. The first place we can take profit at when we enter a trade is when the market comes to a deviation level. All right, remember we've talked about deviation levels. Okay, I showed those to you on a couple of charts. Deviation levels can be settlement. They can be 0.5 deviation, 0.7, 1 deviation, and so on. Okay, so we enter a trade and we can take profit at a deviation level. Okay, for this example here, just an example. Example of using the deviation level as an exit, like in this particular example, 39 pips from entry to where we exited and took profit. Okay, so you enter a trade, we understand where to enter. It hits a deviation level, we can exit the trade. Okay, another option is to wait. Remember, the one indicator we haven't really talked about is these MVP predictors. Remember these triangles? Those triangles, that predictor is in no way used for our entry. Okay, we don't use these at all for our entry. Our entries are the other indicators. These triangles here are not used for our entries. These are to help us with our exits. Okay, so you can either take profit when the market hits a deviation level, or you can take profit when you see the MVP predictors go flat. Remember how we talked about that, right? Like right here, market's coming down, 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 then you see them start to go flat, you could get out. Okay, or right here, coming up, 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 you see right here they start to go flat. Okay, so that's an example. Notice again, just showing you, predictors coming up, predictors going flat. Could mean a turnaround, could mean a chop, but that's a level where you could take your profit because the market's coming up and it's starting to come back down. You want to lock in some of that profit. Right here, it's coming down, 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 starting to come up. You can lock in some profit as opposed to letting it come all the way back against you. So we know where to enter a trade. Once we enter, we can take profit at a deviation level, or when we see the MVP predictors starting to go flat, we can exit there for profit. Okay, now just looking at this example, you might say, oh well, I always want to just get out at a deviation level then, because you know in the other example we got like 30 something ticks, and this one when we waited for it to come back to the MVP we only got 17. Well, you can do that, okay, but there are some examples that we talked about before. Let's take a look here. See how the market's coming down? All right, right here we had a valid crossover. See, here's a good example. What happened? Well, volatile trend line crossed the trend flip from above going down. So that tells us what? Valid X. And since it crossed it going down, what are we looking at? A short sale. But notice when it crossed, these were still green. So it was a valid X, a valid cross, and a valid cross down. which means we're looking for a short sale. But it wasn't till over here where everything lined up red. Because even though right here we had red trend flip, we even had red bands, we even had some red bar color and red trendar, but the volatile trend line was still green. So we couldn't enter right until right here when the trend line turned red, right? Because the trendar can override the bar color, but it can't override the trend flip, the trend bands, or the trend line. So right here was a valid entry and we went short. So when we went short, the market came down to this deviation level here, we could have got out. But what happened? Market kept going, didn't it? So in this case, we could have got out here, but we probably would have preferred to wait and not get out till here when these went flat. How can we know the difference? Well, let's take a look at volume. Okay, not only was when the market gets to a deviation level, like we talked about before, it can reverse, it can bounce there, or it can go right on through it. Okay, well, how would you possibly know, well, hey, is it going to go through it or is it going to bounce? Well, one good way to know is if you decide that you want to just get out at the deviation level and take your profit, no problem. Okay, still a nice little move there. But if you say, you know, I think I want to wait, I think I want to stay in the trade and see if it gives me some more. Well, one of the good things to look at is volume. All right, notice how volume is really exceeding here, like quite a bit, and the market kept on going. Look at this example over here when the market's coming back up to that same deviation level, and it kind of hits it and bounces off of it, and look where volume was. Pretty low, right? See that difference? That makes sense? And another thing that we mentioned before is notice how volume is building and it's stair-stepping. See that? It's constantly getting higher and higher and higher. So if you see that happening when you're coming into a deviation level, not just exceeding volume, okay? Sometimes, yes, just exceeding volume will cause it to blow through, but especially when you see that building stair-step volume, might be a good indication that the market might keep going a little ways. Okay, so for your profit targets, you can exit at a deviation, or you exit when you see the predictors go flat. Like you see this predictor and the next one down, 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 even. That is going flat. You don't have to wait till you have 4 or 5 flat ones. You'll see on that second one, hey, it's not, you know, plotting further down, it's plotting right next to it. I might go ahead and get out there. So if you didn't get out at the deviation level, you can get out when the MVP predictors go flat. Okay, so we know where to enter a long or a short trade. We know what we're shooting for our profit targets. We're either getting out at a deviation level or we're getting out when we see the predictors start to go flat. That way we can lock in some profits. Now, what about our stops? What about if we're just wrong and the market we enter a trade and the market goes right against us? Where do we want to stop? Where do we want to get out if we've not reached our profit target of a deviation? Or what can we do to possibly get out where our stops at? Quick example right here. Okay, follow trend lines coming up, crosses the trend flip, right? We've got green bands, green bars, green, and we hop in this trade going long. Market starts to go up, it immediately comes down. Okay, well, if the market gets 3 ticks below these predictors, sometimes the market can shoot right down and can drop below the MVP predictors before they start to go flat. In this example, that one did go flat, but sometimes if the market moves quickly and maybe this bar just popped way down and it went 3 ticks below the MVP predictor, you would exit. You would exit 3 ticks below the MVP predictor. Okay, a lot of times it'll go flat before that happens and you can get out. But if the market just moves real quick against you, if the market goes 3 ticks below one of these MVP predictors, you can get out and close the trade. That's your stop. Or if 3 indicators go against you. For example, we got in this trade going up, but then look what happened here. Trend bands went red. Right here, volatile trend line turned red, and the trend R turned red. So you can get out. All right, if 3 indicators flip against you the wrong color, you get out. Or if the market goes 3 ticks below the MVP predictor, you get out. That's your stops. Okay, a second ago we talked about where we take profits at deviation levels or flatline predictors. This is your stop. Okay, where you get stopped out, where you place your stops. Kind of another example of that would be here. See this long trend here? Okay, well, we have no idea how long this trend is going to go, right? So we don't want to let the market come up and then come way down against us and lose all our profit. So let's say we entered the trade right here. Volatile trend line comes up from underneath, crosses the trend flip, got green bar, green bands, green everything. We take the trade up, and then look what happens here. Okay, they start to go flat, but also red trend band, red volatile trend line, and a red trend R. So we get out and lock in that profit. Okay, I'm going to show you in a minute when we re-enter. Market comes back up, starts to pop down, everything turns red. Get out, take what we got. Here, if we enter again, market comes up, right, coming up, up, up. 3 things turn against us, we get out. Okay, so it's a way to know where to place your stops, but also to help lock in some of those profits. So we know our entries, we know where to take profit, and we know where to place our stops. Our stops are either 3 ticks below the MVP predictor, or when 3 indicators turn against us. Now let's talk about where and how we re-enter a trade. Okay, so here we had a valid entry, right? Okay, volatile trend line comes down, crosses from above, crosses down into the trend flip. We've got red trend bands, red bar, even a red trend R. So we enter the trade and we're going short, we're going down, okay? And then what happens? The market pops back up, and right here, what do you see happen? Well, we see that 3 indicators, trend R, trend bands, volatile trend line have turned green. Okay, we also see that these predictors are going flat. We get out, right? We're out of that trade. We went short, market started to come up, we got out. Notice here that the volatile trend line turned back to green. Okay, but then right here, what happened? Volatile trend line turned to green, trend flip turned to green, even trend R turned to green. But then here, everything turned back to red. Trend flip is red, trend bands are red, volatile trend line is red. Now we've got a yellow bar, but we've got the trend R momentum is red. So we can re-enter the trade here. On a re-entry, we're not looking for another cross. All right, we've had the cross here. All right, this cross here is validating an overall short trend. Okay, so once this happens, we're only taking short trades. So right here is a valid entry, then a couple indicators flipped the other way, 3 of them did, we got out of the trade. But then when they flip back, and we have all the other rules lining up, okay, trend flip, volatile trend line, trend bands, and either a red bar or a red trend R, we can take another short entry. Okay, and we take that down all the way here. Okay, so we can re-enter getting into these trends. All right, we're just taking the trend down. If it pops back up against us, we get out and lock that in. Okay, or limit our loss, and then when it comes back down again, we take it again. Let's look at another example here. Here's an example on this chart I was just showing you. Okay, got a valid long here. Okay, and we're coming up. What happens here? 3 indicators go against us. This is going flat. Lock it in. Now you might say, well, why don't we just stay in it and keep riding it? Well, live when this happened, you didn't know if it was going to keep going up or go down. So you're glad you locked in what you got there, right? Notice the volatile trend line turned red, trend band turned red. What happens right here? Everything's back to green. Take it on up. Turns 3 against you, get out. What happens here? Okay, now technically, yes, the volatile trend line kind of hit here, but then came back. See that? It crossed and then came back up. We got back in it, took it up. So that is your re-entry rules. Okay, so there you have the entry and exit rules, take profit rules, stop rules, and re-entry rules for the Alchemy system. Okay, in the next video here, we're going to talk about the market analyzer and how you can use that to help you easily monitor multiple markets at one time.